Dennis DeBusschere, President and Chief Market Strategist at 22V Research. And Dennis, I do want to start there. There's been a lot of talk here about economic conditions and whether, I guess, the all clear, or maybe not the all clear, but at least enough clarity for investors to start rotating out of the safety of the Magnificent Seven and into something that's a little bit more economically sensitive, a little bit more cyclical.
Yeah, and you're seeing that today, as you mentioned. To get confidence on that, though, over the course of the cycle, you're going to need to see monetary policy volatility or expected monetary policy volatility continue to come down. That started the year coming down significantly. That's why you had that big broadening out of equities that worked in December, or I guess more 4Q in general. That reversed to start the year because economic growth has been so much stronger than expected. The Fed is hyper-focused on that, and there is some risk that if economic growth stays this strong of a level, then inflation won't come down to a place where they can, lower policy rate in a consistent way, and that would be a problem for an extension of the cycle and a broadening out of into more cyclical assets, into the average stock relative to the Mega 7.
Forgive me if this is a dumb question, Dennis, but for those folks who are looking to small caps, let's just take the Russell for example here, and trying to find whether there is a modicum of safety, is the correlation that they should look at, is that more tied to interest rates or more tied to the economic data itself?
At this point, it's more tied to interest rates. So one of the charts we've been highlighting, and we focus on this today, is the intense, deep negative correlation between relative performance of the Russell 2000 against 10-year yields. So 10-year yields moving up, Russell 2000 is going to significantly underperform. 10-year yields stable to lower, the Russell tends to do very well, assuming, obviously, 10-year yields are not moving lower because recession risk is increasing. So that is where you need to focus. And if we see a move from current levels on the 10-year year to 10-year yields, to 450 or well above that, then that would probably be a pretty big problem for Russell, assuming that's associated with more inflation risk.
So, Dennis, how do the options market, how do options traders or market participants using options to trade the Russell, say, versus the S&P?
That's a great question because the volatility in the Russell is at just an absolute extreme against the S&P right now. So you're looking at the spread between Russell volatility and the S&P volatility, basically the highest it's ever been, so like 98th percentile. So you're seeing significantly more volatility priced within the Russell, which is where a lot of the hedging is going on relative to bad outcomes versus the S&P. So a way to think about this is a lot of potential negativity has been priced in the Russell, and to the extent that we see economic data that's kind of benign, what I mean by benign is data that doesn't suggest inflation's going to move up again, that it can steadily move down towards the Fed's target, you could see a collapse in volatility in the Russell relative to the S&P. And maybe you're starting to see a little bit of that today. We'll see what happens with the economic data over the next week. This will be really important. But this is a really important point, and thanks for bringing it up.
Yeah, you bet. I like options. I mean, I understand about half of it, or less, but still. So Dennis, to that point, I feel like rent the rally for the S&P has been the thing. I mean, like the call volume outmatching the put volume, like there's so many calls going in. It feels like that's the way we're trading now. Play the upside, forget the downside, despite the fact that we're record highs on the S&P. What do you do with that?
I think the one thing you do at an S&P level is fade forward returns. Right? I think you have to say that over the next 6 months, and we looked at this historically in the data, your forward return profile, given what the option market is, and broader investor sentiment is suggesting right now, is that you should have lower than normal forward returns to the tune of roughly 1-ish% over the next 3 to 6 months. Which is not terrible, but that's typically how this stuff has played out in the past. Now, maybe we move into a bubble. Maybe the cash returns of these megas are so intense that, all history gets, market history gets knocked out. But that's the way I would think about it. So I want to be fading the S&P, and I want to be long the Russell and broadening out right now. And that will look very dumb, by the way, if payroll is very hot and interest rates go higher, but that's our call.
Do you hedge that, Dennis, or try to?
If I was going to hedge that, I would be hedging that in debt sustainability baskets. That's where we're so there's a lot of baskets out there that would do very poorly if 10-year yields move higher that have debt sustainability concerns. So the way to think about that is low coverage ratios with high earnings volatility. A basket like that, I think, is kind of an ideal hedge against a spike in interest rates.